Good day, everyone. Today's lecture is focused on understanding the international perspective on transfer pricing. As we know, transfer pricing is a pivotal element in international taxation, governing how profits are allocated between different jurisdictions where multinational enterprises operate. The fundamental goal of transfer pricing is to ensure that transactions between related entities are conducted at arm's length, meaning they reflect the terms and conditions that would be agreed upon by independent parties under similar circumstances. With the increasing globalization of business operations, tax authorities across the globe are paying closer attention to transfer pricing. International frameworks like the OECD and G20's Base Erosion and Profit Shifting (BEPS) Action Plan and the OECD Transfer Pricing Guidelines play a critical role in shaping global and local regulations. Countries like Nigeria are adopting these standards to enhance compliance, transparency, and to safeguard their tax bases. So today we will explore 5 key areas. Today we'll be looking at Module 11, which will be talking about the international perspectives on transfer pricing. And today we will explore 5 areas which include the BEPS action plan and its impact on transfer pricing, OECD transfer pricing guidelines and their practical application, international trends and their specific influence on Nigeria, transfer pricing in Africa and regional trends, the role of double taxation agreements (DTA) in mitigating transfer pricing risk. So let us start with BEPS action plan and transfer pricing. Now, the Base Erosion and Profit Shifting (BEPS action plan) was developed by the Organization for Economic Cooperation and Development (OECD) in collaboration with the G20. Its objective is to tackle tax avoidance strategies that exploit gaps and mismatches in international tax rules. BEPS practices often involve multinational enterprise artificially shifting profits to low tax jurisdictions or tax havens, thereby eroding the taxable base in high tax countries. To combat this, the BEPS project comprises 15 specific actions aimed at reforming the global tax landscape. Several of these actions focus directly on transfer pricing with the goal of aligning taxable profits with the location of value creation. So let's look at the key actions that relate to or key actions related to transfer pricing. Now, the BEPS action plan introduces key reforms aimed at aligning transfer pricing outcomes with value creation. Some of the most relevant actions include Action 8 to 10. These actions focus on aligning transfer pricing with the economic activities that generate value. So the focus is particularly on high-risk areas like intangibles, risk allocation, and capital recharacterization. Now, the objective here is to ensure that profits are reported in the jurisdiction where the actual economic activities and value creation occur, rather than being artificially shifted to tax favorable condition. Now we look at Action 13. This action introduces a three-tiered documentation approach. In our previous modules, we've looked at the master file, we've looked at the local file, and we've also looked at country-by-country reporting. So the master file, which provides a global overview of the multinational operations, transfer pricing policies, and overall financial standing. The local file, which details the specific intercompany transactions within each local jurisdiction, including functional analysis and transfer pricing methods. Now, country by country on its own It gives a breakdown of the allocation of income, taxes paid, and key economic activity across all the jurisdictions where the multinational enterprise operates. So now let's look at let's examine a practical example of how a multinational enterprise might implement these BEPS. Let's just give a case study now. Now, a multinational corporation operates in multiple countries. So, to comply with the BEPS action plan, it adopts the three-tiered documentation approach, which we listed above. The company prepares a master file that outlines its global operations, a local file for each jurisdiction, detailing the specific intercompany transactions, and a CBCR report providing an overview of the multinational corporation income, taxes paid, and economic activities. So by aligning its transfer pricing with value creation, this multinational corporation reduces its risk of audit and disputes. The transparency provided by the documentation helps tax authorities assess potential risk and ensures the company is in compliance with both local and international regulations. Now, that is a case study, that's a practical example now. So let's look at the OECD transfer pricing guidelines. Now, the OECD transfer pricing guidelines are the most widely accepted set of guidelines for applying the arm's length principle to transactions between related parties within a multinational enterprise. Now, these guidelines are recognized globally and serve as the foundation for transfer pricing regulations in many countries. The primary purpose of these guidelines is to ensure consistency and fairness in how multinational enterprises price intercompany transactions. They aim to prevent profit shifting by requiring that related party transactions are priced in the same manner as transactions between independent entities. Now, let's look at the key components of the OECD guidelines. The OECD transfer pricing guidelines provide detailed guidance on several key aspects of transfer pricing, which include the arm's length principle, which the arm's length principle, which is the cornerstone of transfer pricing, is the arm's length principle is the cornerstone of transfer pricing itself. It ensures that transactions between related entities are priced the same way they would be if the parties were unrelated. This principle helps prevent artificial profit shifting and ensures that profits are appropriately taxed in the jurisdiction where value is created. And so let's also look at, under this key consideration, we'll look at the transfer pricing methods. The OECD recommends 5 primary methods for determining arm's length principle. The methods are comparable uncontrolled price method, which is the COP method, resale price method, cost plus method, profit split method, and the transactional net margin method. Now, under the key consideration, we are still looking at under the key consideration, we look at documentation requirement. The guideline emphasize the need for comprehensive documentation. Multinational enterprises must maintain detailed records to support their transfer pricing guidelines and demonstrate compliance with the arm's length principle. This documentation is critical, especially during audit. So let's look at a case study. An European-based multinational corporation follows the OECD transfer pricing guidelines to ensure compliance with both local and international regulations. Now, this company conducts a functional analysis to assess the roles and risks of each entity within its group. Based on this analysis, the company selects the appropriate transfer pricing method. Let's say they selected the transactional net margin method. Now, this company prepares thorough documentation, including a master file, a local file, and supporting benchmarking studies. So when the local tax authorities conduct an audit, for example, let's say FRS, the multinational corporation adheres to the OECD guidelines, and this helps demonstrate compliance, and the company successfully avoids any significant adjustment or penalties that would have happened. So let's look at international trends and their impact on Nigeria. Now, international trends in transfer pricing, largely driven by the BEPS action plan and evolving OECD guidelines, have a significant impact on countries like Nigeria, as tax authorities across the globe focus more on transparency, value creation, and global cooperation. Countries like Nigeria are aligning their transfer pricing regulations to reflect these changes. So these trends influence not only the regulatory landscape but also enforcement practices and compliance requirements for businesses operating in Nigeria. So let's look at the key trend that is affecting Nigeria. Some of the key international trends that are shaping transfer pricing in Nigeria include increased transparency, enhanced documentation requirements, particularly with the adoption of country by country reporting, are improving transparency and providing tax authorities with better tools to assess transfer pricing risk. Alignment with value creation too, there is a growing emphasis on ensuring that transfer pricing outcomes are aligned with the value creation activities of the business. This is particularly relevant in high risk areas such as intangible asset and service transaction. Now let's look at global cooperation. Tax authorities are increasingly cooperating on a global scale to address BEPS concerns. These include data sharing, exchange of information, joint audits, and mutual assistance in transfer pricing cases. So the impact on Nigeria is that Nigeria has also responded to all these global trends by updating its transfer pricing regulations to align with international best practices. In particular, Nigeria has adopted the three-tiered documentation approach and has increased its focus on transfer pricing audits and enforcement. So the Nigerian transfer pricing, the Nigerian tax authorities, which is the Federal Inland Revenue Service, are using international guidelines and data sharing agreements to, to enhance their compliance program and ensure that multinational enterprises operating in Nigeria are adhering to global standards. So a case study now, let's consider the case of a Nigerian multinational corporation. To align its transfer pricing practices with international standard, the company prepares comprehensive documentation that includes the master file, local file, and the CBCR reporting. So the multinational enterprise conducts regular reviews of its transfer pricing policies and proactively engages with FRS to ensure compliance. So by taking this proactive approach, the Nigerian multinational corporation is better positioned to navigate the evolving regulatory landscape, avoid disputes with tax authorities, and mitigate transfer pricing risk. The focus on transparency and thorough documentation helps the company demonstrate compliance and reduce the risk of audit. So this is another case study. Now let's look at the transfer pricing in Africa. African countries are increasingly adopting transfer pricing regulations to protect their tax bases and attract foreign investment. Now, the OECD guidelines and the BEPS action plan are playing a major role in how African nations formulate and enhance their transfer pricing rules. Now, the key regional trends in Africa includes regulatory harmonization. Many African countries are harmonizing their transfer pricing regulations to align with international standards, particularly those set by the OECD. This harmonization ensures consistency in how transfer pricing rules are applied across different jurisdictions. Now, the key trend again is that the African tax authority are building capacity. African tax authorities are investing in training and resources to enhance their capacity to manage transfer pricing issues. This includes developing specialized teams that focus on transfer pricing audits and monitoring compliance. Then also regional cooperation have also increased. There is an increase in collaboration among African tax authorities, particularly through the regional bodies like the African Tax Administration Forum, ATAF. This cooperation allows for the exchange of information and joint efforts to address transfer pricing risk. So Africans are beginning to wake up now to reduce profit shifting from Africa to low tax haven or to other jurisdiction. So let's consider an African multinational corporation operating in Kenya, South Africa, and Nigeria. This multinational enterprise or corporation adopts a standardized transfer pricing policy across its operation to ensure compliance with local regulation and international guidelines. So the company actively engages with local tax authorities and participates in regional tax forums like the ATAF to stay updated on regulatory changes and best practices. So, adopting a cooperative and transparent approach, the multinational corporation is able to navigate the complex and evolving transfer pricing landscape in Africa. So, let's look at transfer pricing and double taxation agreements. So, double taxation agreements are bilateral treaties designed to prevent the same income from being taxed in more than one jurisdiction. These agreements play a critical role in managing transfer pricing risk by providing a mechanism for resolving disputes and avoiding double taxation. And the key provisions here or consideration is that we have mutual agreement procedures and we have arbitration. So now let's look at the mutual agreement procedures first. I'm sure we've discussed this before. Mutual agreement provisions allow the tax authorities of the contracting states to consult and resolve transfer pricing disputes that arise between them. This cooperative process is aimed at preventing double taxation and ensuring a fair allocation of profit between the jurisdictions. Now, for arbitration, if the mutual agreement procedure fails to resolve a dispute, many double tax treaty or many double tax treaty agreement or double tax agreement provide for arbitration as a final resort. Arbitration ensures that unresolved issues are decided by an independent party, helping to avoid prolonged conflicts. Sorry. Okay, so that's that. Let's look at a case study with respect to double taxation agreements. Now, let's consider a multinational company facing transfer pricing disputes involving its operation in Nigeria and the UK. The company invokes the mutual agreement procedure provision under the Nigerian UK DTA. Through the mutual agreement procedure, the tax authorities of both countries enter into negotiation to resolve the dispute. Now, the mutual agreement procedure helps avoid double taxation and ensure a fair resolution based on agreed upon transfer pricing principles without resorting to lengthy litigation. So, in conclusion, international perspective on transfer pricing driven by initiatives like the BEPS Action Plan, the OECD guidelines, have a profound impact on global and regional transfer pricing practices. Now, countries like Nigeria and other countries across Africa are aligning their regulations with these international standards to enhance transparency, foster global cooperation, and better manage transfer pricing risk. Double taxation agreements play a crucial role in preventing double taxation and providing mechanisms for resolving disputes, contributing to a more stable and predictable tax environment. So, by understanding these international trends and leveraging relevant case studies, as we've mentioned in this particular module, businesses can navigate the complexities of transfer pricing more effectively and ensure compliance across Africa. Thank you for your attention.